Let's unpack those movements now with Viv Govender from Rand Swiss. Viv, thanks so much for joining us. There's a big rebound in the market after a volatile few days. Why is that?
A couple of bits of news. Firstly, we had the US debt ceiling deal being done. That, I think, was just a extra bit of uncertainty in the market. Look, it was almost certainly going to be done, but the consequences of our deal not being done were just so great that the market was a bit nervous about it. So that is to a certain extent finished. It's gone through Congress. The Democrats control the Senate, which will go next, and of course they have a Democratic president. So there should be reasonably smooth sailing from here. And the second thing is the jobs numbers that came out today, non-farm payroll numbers, that kind of supported the Fed basically taking a bit of a pause, and that I think should be positive in the market as well.
The Rand also clawed back quite a bit of its major losses. Is it just because of the dollar, or are there other factors that also helped us today?
I think a lot of it is the dollar. A lot of it is a reduction in global uncertainty. Remember, the Rand does weaken when there's global uncertainty. And I think also, if you look at the reason that we are above 1950, it's not to do with any economic news. It was that announcement from the U.S. ambassador about us selling arms to the Russians. And I think as that story basically doesn't develop over time, some of that fear goes down. That being said, I mean, the Reserve Bank did come out with a report this week and did mention this was a major threat to the country, the threat of sanctions. So it still remains an issue, but I think that is also, that story kind of is not developing too much forward. It does help us a bit.
Staying with the US, there were better than expected job numbers out of the US. Why is this important, and why should we look to this?
Well, actually, the better than expected job numbers are actually not the positive thing, because generally what the US Fed wants to do right now is it wants to basically have the economy come under a bit of pressure. But what we are seeing is more people returning to the job market, which shows that people are under pressure, and that's a positive actually, because the way the Reserve Bank controls inflation, this was all about inflation, is by making things more difficult for consumers and businesses out there. High interest rates, high interest rate payments, you can't buy as much, that kind of stuff. The fact that they're seeing consumers not having, or workers not having wage increases as high as they once had, the unemployment rate rising, people returning to the job market because they need to. Those are factors that are actually positive in terms of calling for a pause to the rate hike, and I think that's what the market's reacting to, rather than the really strong total number of people finding work.
Interesting. Now back to the local market, Nedbank announced in its trading update that it's upping its provisions for impairments. Do you think we can expect similar provisions to come from other banks because of the current climate, or have they already done so?
So look, I think we all expect that to come through. I mean, even away from the banking sector, this is a real phenomenon in the market. It's not a banking phenomenon. Look at Tiger Brands, and what they said was that it's the worst consumer environment in 25 years. Look at spending across different sectors in this economy, and you're seeing really staple spending under pressure. And so I think this is a real phenomena. The banks are no bank is immune from it. It's working across different segments of the market. And so I think all banks will have to do something similar to basically adjust to a suffering consumer, quite frankly.
So Clicks has gotten the go-ahead to acquire Sorbet. The competition tribunal has approved the merger, and one of the conditions is that an employee share ownership program is established. What is your thoughts on this?
Yeah, South Africa has a very strange way of doing, competition commission stuff. Often they're more concerned with the employees than with customers, quite frankly. And if you look at places like the US, as long as the customer doesn't suffer, actually employee, numbers going down is often thought as being a positive. South Africa follows a slightly different pattern, similar to what the Europeans do. Look, I'm not so sure that this is the role of the Competition Commission. The Competition Commission should be existing in order to ensure that there's competition in the South African economy, not to basically do things like, for instance, have employment schemes being created or employee share schemes being created by companies. That's not what their remit is. I think it's beyond what they should be doing. And the reason I bring this up is not to say that employment or employee share schemes are a bad thing. Is that competition and creating more competition in the economy is a good thing. You don't want a institution that's created to do a good thing being distracted by doing other things as well. So that's what kind of the problem I have with this, kind of expanding, jurisdiction of the Competition Commission.
Thank you for your insights, Viv. That was Viv Govender from Rand Swiss.